Hello and welcome back to the Deep Dive. It is Tuesday, February 17th, 2026. And I have to be honest with you, today's stack of sources, it made my head spin a little
It's
bit.
a lot.
Yeah, we usually talk about trends or gadgets, but today, all the sources are telling this very specific, very expensive story. We're looking at the sheer price tag of the future.
And let me tell you, the sticker shock is real.
Hmm.
I mean, whether you're a trillion-dollar tech giant, a legacy automaker, or, just a parent trying to pay off a student loan, the cost of staying in the game just went up.
Significantly, it really has. It feels like we're watching a high-stakes poker game where the blind just jumped from like $10 to $10 billion.
Right.
We're seeing companies betting these massive amounts of capital on AI while their stock value just evaporates. We've got legacy automakers basically admitting defeat on their own engineering just to survive.
And the Lakers.
Yeah.
Even the most famous family dynasty can't afford the modern price of a championship ring. It's a diverse stack of stories, for sure, but the through line is capital intensity.
Yes. We're moving from an era of growth at all costs to spending to survive.
That's a great way to put it.
So here's the roadmap for this deep dive. We are going to start with Amazon and a losing streak that we haven't seen since the dot-com bubble. Then we're going to untangle this chaotic bidding war for Warner Bros. Discovery.
Oh, that's a mess. Netflix and Paramount are involved.
A total mess. Then we have a critical, and I mean critical financial deadline for parents with student loans. That's coming up fast. And finally, we'll break down the sale of the Lakers in a Model T moment for Ford.
All right, let's get into it.
We have to start with Amazon. I was looking at the terminal this morning, and the numbers are just, wow, they're staggering. Amazon is eyeing its 10th consecutive day of losses.
Which ties their longest losing streak on record. The last time the chart looked like this, it was 1997.
That context is so heavy. In 97, they were just selling books. Now they run, what, half the internet?
Pretty much. And the damage isn't small. We're talking about $450 billion in market valuation wiped out.
Since February 2nd. That's like the entire GDP of Austria just gone, vanished in 2 weeks. And the sources suggest this is self-inflicted, so why is the market punishing them so hard?
It's a revolt against one word: CapEx. Capital expenditures. Amazon announced they expect to spend $200 billion in CapEx this year.
200 billion, just to clarify for you listening, when we say CapEx, we aren't talking about salaries or marketing.
No, this is physical stuff. Concrete, steel, servers, data centers, cooling systems, the hard assets. And that $200 billion figure is 60% higher than last year.
And 50 billion more than Wall Street expected?
Exactly. So Wall Street looked at that number, looked at the free cash flow, and just blinked.
They panicked.
Completely panicked. Investors, they love a vision, but they love cash flow more. They're terrified that Amazon is basically burning the furniture to heat the house.
And they see this massive spend as a sign that the returns on AI are going to be much more expensive to get than anyone thought.
But CEO Andy Jassy is doubling down. He's telling analysts, trust me, this will yield strong returns.
But is he delusional, or does he know something they don't?
I think he knows he has no choice. This is the prisoner's dilemma of AI. If Amazon stops spending, they risk becoming irrelevant. If you combine Amazon with Alphabet, Microsoft, and Meta, these companies could hit $700 billion in CapEx this year.
It's an absolute arms race, a game of chicken.
Yeah.
And if you want to understand the panic, why they feel the need to spend that money, you have to look at the speed of the technology itself. We have to talk about Anthropic.
This is the catalyst. This is what's causing the entire market freakout.
So Anthropic just released Claude Sonnet 4.6. Now, usually these updates are spaced out maybe 6 months, a year. But do you know when they released the previous model, Claude Opus 4.6?
Go on.
12 days ago.
12 days. That is the terrifying part.
It's insane. I mean, I have milk in my fridge older than the last state-of-the-art AI model, and this new one, Sonnet 4.6, specializes in using computers and, well, coding.
And that specific capability, the coding, that's why the whole software sector is bleeding out. Traditional software stocks are down about 20% year to date.
Because if the AI can code better than the software engineers.
Exactly. The market is pricing in a future where AI writes the code, maintains the code, and updates the code. So, I mean, what's the moat for a traditional SaaS company? Why pay for a seat license when an AI agent can build you a bespoke tool in seconds?
So investors are dumping software stocks because they might be obsolete, And they're dumping the cloud giants because they're spending too much to build the thing that makes the software obsolete.
It feels like there's nowhere to hide.
Well, there are some picks and shovels winners, right? If you look at the startup ecosystem, you can see where the value is going. Look at Render.
Right, the cloud infrastructure startup. They just raised $100 million at a, what, $1.5 billion valuation?
But the why is the fascinating part. It's not because they have the best sales team.
No, not at all. They're growing because AI chatbots are telling developers to use them.
So a developer asks ChatGPT or Claude, hey, where should I host my app? And the AI just says, Render.
That's it. The AI builds the code, and the AI decides where the code lives. It's completely closed loop. The AI is becoming the gatekeeper for internet infrastructure.
That is a profound shift. If you aren't the AI's preferred vendor, you might not even exist. Speaking of shifts, we should quickly mention Palantir. They're moving their headquarters.
Yes, officially moving from Denver to Miami.
Joining that whole migration, you've got Bezos there, Ken Griffin there.
It's a strong signal.
Yep.
Palantir's CEO, Alex Karp, has been really vocal about clashing with Silicon Valley values. Miami is, it's becoming the capital of hard tech, defense tech, and, let's be honest, lower taxes.
It seems like the map of power is being redrawn both digitally and geographically.
Absolutely.
Okay, so we have tech giants burning cash to survive the AI wave. Let's pivot to the entertainment industry, where burning cash is, well, it's basically the business model. There's a massive consolidation battle brewing with Warner Bros. Discovery.
Oh, this is getting very messy. It's like a classic love triangle, but corporate style.
Okay, set the scene for us.
So you have Warner Bros., Discovery, or WBD. They had a pending merger deal with Netflix. It was clean, it was simple.
But then Paramount Skydance comes in and crashes the wedding.
Like a scene right out of one of their own movies, Paramount Skydance launched a hostile tender offer directly to shareholders at $30 a share.
For those who aren't finance pros, what's a tender offer? How is that different from a normal buyout?
A normal buyout, you negotiate with the board of directors. A tender offer, you just bypass the board entirely and go straight to the stockholders. You send them a letter saying, I'll give you $30 cash for your stock right now.
Which puts massive pressure on the board.
Huge pressure. Because if the shareholders want the cash, the board looks like they're standing in the way of a payday.
And WBD's board called the offer deficient. But here's the twist. Netflix granted WBD a 7-day waiver.
Oh.
Yep. Netflix basically said, okay, you have 1 week. Go talk to Paramount Skydance. See if they have a best and final offer. Get it out of your system. Why on earth would they let them shop around?
Because Netflix is playing 4D chess here. They are incredibly confident that the Paramount deal is a regulatory nightmare.
Ah, because of where the money is coming from.
Precisely. Paramount's bid is funded partly by sovereign wealth funds from Saudi Arabia, the UAE, and Qatar.
Which brings in the regulators.
Big time. That triggers CFI-US, the Committee on Foreign Investment in the U.S. Netflix knows that a deal like that will get bogged down in Washington and Brussels for like 18 months.
So they're betting WBD will look at that regulatory headache and come running back to the Netflix deal for the certainty.
Even if the price is lower. It's amazing, isn't it? Geopolitics is now a standard line item in media mergers.
You can't just look at the price. You have to look at the passport of the money.
That's the world we live in.
Speaking of media headaches, we have to touch on this thing at CBS, which is Paramount's parent company. Stephen Colbert is fighting his own network.
This is a really significant moment. Stephen Colbert went on air and just ripped CBS for blocking an interview with Texas Representative James Tallarico.
Tallarico is the Democrat running for Senate, right?
He is. And CBS lawyers stepped in and said, nope, you can't have him on. Their reason was the FCC's equal time rule. They were afraid that if Tallarico went on Colbert, they'd be legally required to give equal airtime to his opponent, Representative Jasmine Crockett.
But Colbert didn't just accept that.
No, he called it out on air. It highlights this tension between legacy media compliance, these old rules from the broadcast era, and the modern political landscape. CBS is terrified of regulatory blowback.
Especially with all these mergers in the air.
Exactly. They're prioritizing compliance over content. When billions are on the line, nobody wants to rock the boat.
Okay, let's shift gears from the corporate boardroom to your wallet. If you are a parent who took out loans for your kids' college, you need to listen to this next part very, very carefully.
This is probably the most actionable advice in the whole deep dive. We're talking about parent PLUS borrowers.
There is a deadline approaching. July 1st, 2026. This is under the new One Big Beautiful Bill Act.
Correct. And starting July 1st, parent PLUS borrowers will lose access to income-driven repayment plans, IDR.
Okay, break that down. What's IDR, simply?
Sure. With an IDR plan, your monthly payment isn't a fixed number. It's a percentage of your discretionary income. So if you retire and your income drops to Social Security, your loan payment drops with it. It protects you.
And if they miss this deadline and the new law kicks in,
They get forced into a standard repayment plan. That's a fixed term, 10 to 25 years. If you have a $100,000 balance and you're retired, that fixed payment could be $800, maybe $1,000 a month.
wow, that's a financial disaster for a retiree. So what do they need to do?
You have to consolidate your loans into a direct consolidation loan, and you need to do it by March 34.
March 31. That is the date to mark on your calendar.
Yes. Consolidating by then locks in your eligibility for those IDR options before the window just slams shut on July front.
Okay, consolidate by March 31. Now, there's a weird twist here with the current administration, right? The one big, beautiful bill is tightening the rules, but some numbers tell a different story.
It's very counterintuitive. A recent court filing showed that the Trump administration actually identified 40,000 more borrowers eligible for forgiveness just last month, in January.
Wait, really?
Yeah.
Under the old rules?
Yes. It's a mix of borrowers on IDR plans and public service loan forgiveness. So even as the administration overhauls the system, the machinery of the old bureaucracy is still churning.
So the government is simultaneously tightening the rules and forgiving loans based on the old math.
It's a bureaucratic twilight zone.
Speaking of government chaos, we have a partial shutdown at the Department of Homeland Security.
We do. DHS is in a partial shutdown. Democrats sent a counteroffer, but the sticking point isn't just money. They're demanding specific restrictions on immigration agents, like mandatory body cams and masks.
It seems like every budget cycle now comes with a policy fight attached.
It does. And while Washington argues, the Middle East is heating up in a very confusing way. Iran partially closed the Strait of Hormuz for military drills. Now, normally when you hear Strait of Hormuz close, you expect oil prices to spike.
To $100 a barrel, yeah. That's the choke point of the world.
But Brent crude actually fell to $67.42.
It makes no sense on the surface.
Oh, why?
Because diplomacy outweighed the physical threat.
Oh.
At the same time the drills were happening, the U.S. and Iran made significant progress in nuclear talks in Geneva. So the market decided long-term de-escalation was more important than the short-term drama.
A rare moment of optimism winning out over fear in the energy markets.
Very rare.
Okay, let's move to our final segment, a different kind of power struggle in the NBA. The Los Angeles Lakers are being sold. This is the end of an era. The Buss family is selling the team to Mark Walter, who owns the Dodgers.
For a staggering valuation, $10 billion.
It sets a new benchmark for sports franchises globally, for sure.
But what struck me was the reasoning. Jeannie Buss and her siblings are selling, and ESPN reported there was conflict, which isn't a shock, but Jeannie made a really interesting point about the roster.
Right. Let's look at the team context. About a year ago, they traded Anthony Davis for Luka Doncic.
A massive, massive trade. Luka is the future of the league.
He is. But building a championship team around Luka, especially with LeBron James, now 41 and his future uncertain, that requires huge capital.
Jeannie basically said, we need deeper pockets.
It comes down to family wealth versus institutional wealth. The Buss family is asset-rich. They own the team. But they are cash poor relative to the billionaires and private equity guys coming into the league.
To pay the luxury taxes, build the facilities.
Exactly. To compete in the modern NBA, you need access to liquidity that a family business just doesn't have anymore. Mark Walter isn't just a rich guy. He's institutional-grade capital.
So the Lakers are spending to survive at the top.
Spending to win. And in 2026, winning is very expensive.
Speaking of iconic American brands reinventing themselves to survive, let's talk about Ford. They're launching a $30,000 electric pickup in 2027.
This is Ford's Model T moment, according to their CEO, Jim Farley. But what's really fascinating is how they're doing it.
They're stealing from the playbook of their biggest rival.
They are, in effect, admitting Tesla won the technology argument. Ford is adopting Tesla's 48-volt electrical architecture.
What does that mean for someone who isn't an engineer? Why does 48 volts matter?
Think of it like plumbing. Most cars run on a 12-volt system. That's low pressure. To move power, you need big, heavy copper wires, like thick pipes. A 48-volt system is high pressure. You can use tiny, light wires.
Which saves a massive amount of copper, weight, and money.
A ton. And they're also using gigacasting. Instead of welding hundreds of little metal parts together for the frame, you use A giant press to cast the frame in huge chunks.
Another Tesla invention.
Right, so it's a 100-year-old company swallowing its pride and adopting the disruptor's methods just to get the price down.
It's a survival strategy. They realized they couldn't build cars the old way and still turn a profit.
They had to change everything.
Before we wrap up, we do want to take a moment to acknowledge the passing of a giant. Reverend Jesse Jackson passed away at age 84.
A monumental figure. I mean, whether you look at his time on the balcony with Dr. King or his 2 presidential runs in the 80s, he truly paved the way for the diverse political coalition we see today. A relentless agent of change.
Absolutely. A huge loss. So let's bring this all together. We started with Amazon spending $200 billion to keep up with AI. We talked about Netflix and Paramount battling for scale. We see the Lakers selling for $10 billion just to afford a roster.
And Ford completely reinventing its manufacturing process just to sell a truck.
The theme here is clear. Future-proofing is incredibly, incredibly expensive.
It is. And if we connect this to the bigger picture, it raises a really provocative question. We're seeing a barbell economy emerge. On one end, you have the giants Amazon, Microsoft, Google spending $700 billion. On the other end, you have tiny startups using tools like Render to move fast.
But what happens to everyone in the middle?
That's the danger zone. If you aren't huge enough to build the AI or small and agile enough to leverage it instantly, you might just get squeezed out. Are we entering an era where innovation is a game only for the very rich or the very small?
That is a scary thought for the mid-sized business.
It's the tension of the next decade.
That is definitely something to mull over. If you are a parent with student loans, please go check your status before that March 31st deadline. Don't let the one big beautiful bill catch you off guard.
Absolutely. Knowledge is power, but only if you use it.
Thanks for listening. We will see you in the next deep dive.